We always talk about QE to the moon and extreme QE, and we've brought the Fed's balance sheet down. So we're QTing for the last year and a half or so, and the Fed's trying to tighten and do the right thing. But what people don't realize is that that's real QE, that's direct QE. But for the last 4 years, we've been doing indirect QE, whether it's Yellen issuing from the short end of the yield curve to take pressure off the long end, whether it's emptying out the Treasury General account, whether it's the reverse repo market, whether it's this new attempt, and I think it will become real very soon, to get exemption from supplementary leverage ratios, which is a wonky Wall Street term, which just means that the too big to fail banks can float interest and buy treasuries off the balance sheet of the Fed themselves, hold them and get a reward for it. So that's really too big to fail banks doing QE for the Fed. So there's all these different ways we're creating liquidity or QE-like liquidity measures to save our bond market. And eventually, I think it will just be the direct red button at the Eccles building, just start printing. And I think the only reason Powell cut the balance sheet from 9 to 7 trillion was so he'd have something to fatten when the recession becomes official. I think the only reason he was raising rates from 0 to 5% plus was to have something to lower when the recession becomes official. I think it was just trying to reload the only two guns he has: control the money supply and control the balance sheet and control the price or the interest rate. Eventually, I think the bond market gets the last laugh on yields and interest rates, not the Fed. And eventually, even with stable coins swamping up or mopping up some of this or sponging up some of these treasuries, the world's dumping treasuries. China, Japan, dumping treasuries, usually to buy energy, to buy oil. They're dumping treasuries because it's a weaponized dollar post-Ukraine. They're dumping treasuries because America has too much debt. They don't trust the issuance. They don't trust this IOU like they used to. So there is a real bond crisis, sovereign bond crisis globally, but in the US in particular. And you understand the bond market. You understand everything else, in my opinion. And the fact is, we need someone to buy our debt, because whoever's in office, we're going to be issuing more debt. We're going to be spending more than we bring in tax receipts and GDP. So we float that delta with IOUs. The world used to trust them. Post-2022, they don't as much, hence the BRICS rise. Our debt levels have just gone astronomical, so we're an issuer from a poor credit of an asset that's declining in value. So this bond market is essential to save. And throughout history, going back to ancient Rome, I've said many times, pick your spot in the calendar or the map, whether it was Yugoslavia in the 90s, France in the 1800s. Obviously, the US today, you have to choose, just like in Japan, between your bond market and your currency. What are you going to let die? It's not going to be your bond market. You survive off debt and credit and IOUs. So you sacrifice your currency, you debase it, you overproduce it, you overcreate it, and you bring interest rates to the floor to make it even more debased and cheap so that you can float more of your debt and create more debt. And that debt just postpones and postpones the inevitable destruction of so many things, including the purchasing power of your currency, which is all tied to gold and inflation. But yeah, I think it's absolutely essential right now to save the bond market. And they'll do that by debasing the currency. And the DXY right now has gone higher since Trump. By the way, it went higher too when he was elected in 2016. And by the way, even yields are going higher as the Fed is cutting the Fed funds rate. It's a very interesting time. But, for those who want to think back, Bush, when he's elected in 2001, the DXY went from 108 to like 120 or 121 as Greenspan was furiously cutting rates. So the Fed doesn't always have control of the direction of the dollar. And right now you're seeing this kind of Trump tailwind, this strength in the DXY and the dollar. And I think on a relative basis, absolutely, the US dollar is the best horse in the glue factory. I've said many times, if I was an American in Argentina or in Istanbul, I'd much prefer a dollar to a lira or a peso. But in isolation, the purchasing power of that dollar, regardless of its relative strength on the Dixie, is getting eaten alive every day because of invisible inflation and actual inflation. And I think under Trump, his campaign promises to kill inflation. There's a lot of things I like about Trump's campaigns and a lot of things about his ideas that I like, but I don't think Trump is going to kill inflation. He wants a weaker dollar. He talked about it. Hell, even Harris wanted a weaker dollar. I think his Treasury Secretary wants a weaker dollar. That is going to be inflationary. And we could talk about Trump's other ideas too, which I think are going to be inflationary. If I was his advisor, I would have kept off on the inflation thing, but I've talked about the other things he wants to do, but I wouldn't have promised no inflation. That reminds me of the other Bush president, read my lips, no more taxes. That was an iconic moment. And of course, that cost him the election because he had to raise taxes. And I think in a similar vein, Trump's going to have to inflate or die. And I think we're going to need more inflation. I don't see any way around it. That doesn't mean we can't have disinflationary forces like a market mean reversion or a recession. but it's in our best interest to have a weaker dollar. And yet these policies like tariffs, reshoring of American jobs, which, you can argue pro or con, I certainly am in favor of reshoring American jobs in manufacturing. And even these mass deportations, these are going to be expensive. They're going to be inflationary. And so again, a lot of things you can like about these promises, but in terms of the dollar, I think the trading range for DXY, like Gunlak, is somewhere between 100 and 110. I don't see it going to 150 or 70. I see the dollar getting a boost right now, but I think ultimately in isolation, the purchasing power of that dollar is just going to be debased, because that's how you inflate your way out of a debt crisis. It's what anyone would do. It's what he has to do. Anyone who really tracks gold as a long-term investment understands the historical risk and the political risk and the currency risk that goes with it. And it's not as if we're so high conviction on gold because gold gets shinier or suddenly gold gets more valuable or gold's going through a cyclical cycle of bull market. No, it's not that gold's in a bull market. It's that fiat money is in a tremendous bear market around the world, and including the world reserve currency. And they're in a fiat bear market because they've overproduced. They've expanded the broad money supply by 5x in 20 years. That's inflationary. That's adding water to your wine. That's debasing your currency to pay your debt. All countries, it's not just the US, global debt is off the charts at all record time highs. Its GDP is only 1/3 of that. So in the world in general, in the US in particular, the home of the world reserve currency is this grotesquely and negligently and criminally in debt. You're going to debase your currency. And that's why gold doesn't go higher because it's just getting nicer or there's more jewelry demand. It's because the dollar and fiat money is getting weaker. And even the idea of Bitcoin coming in to save the day, that's a desperate argument, not a future solution miracle. Again, some Bitcoin diehards would disagree with me and say, just be patient, it's coming. I don't see that. And it's not because of a bias. It's just because history confirms that the only real asset, the only real precious money, a real precious metal is gold and silver, in particular gold. And gold's only going to go higher, and because fiat money is going lower. And fiat money is going lower because debt is not going to get better in the next 4 years, no matter what Trump decides to do. And it's worth talking about his laudable decisions to cut the spending with the Department of Governmental Efficiency, to cut some of the waste and the bureaucracy in DC. But again, that's an inflationary move. You can give a lot of pink slips to the Department of Education or the Department of Agriculture and cut the fat in DC, which certainly feels good to a lot of people who see DC as like a Soviet-like bureaucracy of just a lot of corrupt, lazy people doing nothing and taking a check. Okay, you can understand the optics of that. And if certainly if Vivek and Elon can do that better than anyone, they can create pink slips. Musk has shown he can do that in a lot of places. That's fine. But again, all those people you're going to give pink slips to are going to go on the dole or need some other kind of support. That's going to be expensive. They're going to be unemployed probably for a long period of time. Okay, some people may not feel sorry for that, but that's still a cost. But the other thing is, if you just bring the interest rate down by 25 basis points, that saves you $25 billion in interest expense. So cutting rates will do more for dealing with our debt problem than just firing a lot of people in DC. Now, despite all the optics of cutting the fat, which I like in DC, the real faster solution is $25 billion just by cutting interest rates by 25 bips. Because you have to fire a lot of people in DC to get the equivalent of $25 billion in salaries that you're saving money on. So I think the aim of DOGE is to cut $2 trillion in spending in the U.S. the next 2 years by our 250th birthday. That's a big headline. And that's great. Cut that spending. But to me, that is not going to change the fact that we're still going to have trillion-dollar deficits. We're still going to have a debt crisis. If you really want to cut spending to make an impact on inflation, you're going to have to cut entitlements in military by probably 40 to 50%. Now, if he does that, I'll rethink the inflation argument overnight. And I'll even rethink the gold price overnight. But I don't know if that's politically survivable or possible to cut entitlements and to cut defense. I don't know if that's a political viable option. I highly doubt it. I have to also understand that Trump's coming into a White House in 2024 where entitlements, interest expense on our debt and defense is 75% of our budget. There's not a lot of wiggle room besides that. And it is also more than 100% of our tax receipts. So when Trump came into the White House in 2016, those same costs were about 65% of our tax receipts. We're running out of options. The debt has gotten that extreme. And despite all the best efforts of Vivek and Elon to cut fat in DC, our deficits and our debt levels and our spending are still more than our tax receipts and our GDP. And so we're still going to have to create synthetic liquidity out of thin air, not enough to stable coins can absorb, and that's going to be inflationary. So that's inflate or die. It's debase or die. And, since 1971, we went up the gold standard. We took that chaperone away. You know as well as anyone else that the inherent purchasing power of all the major currencies, including the world reserve currency, is lost over 98% when compared against gold. So again, gold isn't getting stronger. Debt has made currencies weaker. And that is why the BRICS have no longer trusting the U.S. Treasury as a reserve strategic asset. And that is why the Bank of International Settlements has made gold in 2023 a tier 1 asset for storing as a strategic reserve asset, not the U.S. Treasury. Yes, the U.S. Treasury is still listed as a tier 1 asset, but the world is moving away. The puck is moving away from U.S. Treasuries, and gold has become the asset you save in, and then you spend in fiat. So that open decline in interest in U.S. Treasuries since 2014, all central banks have been net sellers of U.S. Treasuries and net buyers of gold. Watch the direction of that hockey puck. I can't reiterate it enough. These things are not headlines for headline's sake, and they're not gold bug sensationalism. It's the movement of current history. The BRICS rise is not a joke. Doesn't mean they're super powerful and Russia and China don't have problems and they're going to take over the world, and I'd rather live in Shanghai or Moscow than New York or Los Angeles. I'm not saying that, but let's be realistic. And there's a reason why 30 countries are repatriating their gold in their own zip codes, and why 45 nations trade outside of the US dollar, and why the UAE and Saudi Arabia are selling oil now outside the dollar, and why China is buying oil from Russia in yuan, and Russia's converting that yuan into products they buy out of China and then converting it to gold, and that's selling it in gold on the Shanghai exchange. Gold is being used as a medium of exchange. It is being used as a store of value, unlike Bitcoin, in real-term ways right now, in momentous ways that the media does not want to talk about, because the media is owned, as I've written before, by 5 companies, 5 boards, 5 perspectives, and they lie through omission. They lie by not talking about what it means that the BIS made gold a tier 1 asset, what it means when 20% of oil is now being sold outside of the petrodollar system, what it means when the Saudis and the UAE are talking to China and the BRICS and joining the BRICS and already talking about net settling oil outside of the US dollar. These are massive implications on the demand for that dollar. And again, it doesn't mean the end of the dollar. It doesn't mean the end of the world reserve currency status. It just means that weaponized dollar is trusted less, wanted less, it's demanded less, it's going to get weaker despite all the other things of the milkshake theory. And the other thing about Trump with his tariffs, I understand the optics of make America great, focus on America, focus on manufacturing. Tariffs traditionally are to protect American manufacturing, American productivity. But let's not forget that in 2001, when we let China into the World Trade Organization, and we said this is going to be great because China's going to buy all our toasters and all our cars and all our tires and all our ham radios, the opposite happened. China makes all our cars, our tires, our toasters, and our radios, because American companies, CEOs, offshored all that labor to cheaper labor in Asia and some parts of Central America. They fired millions of employees in America. In short, the American dream is now made in China. So if you're going to have tariffs to protect American manufacturing, we're not really protecting much manufacturing. It's all offshore. And you can thank the CEOs of Apple for that. You can thank the CEOs of almost every product you buy in a Walmart, because more than 90% of it is made in China, even though it has an American flag on it. That's the problem of greed in the C-suite. That's the problem of CEOs who get paid on their share prices, and they don't care to fire millions of Americans to get cheaper labor offshore. So these tariffs are going to be inflationary as well. And the real sinner isn't necessarily just foreign markets. It's the American CEOs who fired all their labor so they could get it cheaper overseas. I think what the tariffs can do is convince American companies who have labor overseas, who have to export things back to America, you know what? With all these tariffs, we should just bring everything back to America. And for that, I see what Trump is trying to do. And for that, I applaud him, because the only way for America to be great again is to make productivity count again. It's the P in GDP. We shouldn't offshore that to Asia. But that takes more than 2 to 4 years to do. And that can't be done easily without walking through some real manure to get there. And that's the problem I worry about with Trump. I think he means well. I don't think it's fully clear to the world, though, how expensive and how hard it's going to be. It's the right direction, but you can't get there without immunity. You can't get there without inflation. You can't get there without more debt, and you can't get there without more costs. And it goes to Paul Tudor Jones' point, all roads lead to inflation. We have to debase, we have to inflate to pay for these great ideas that the Trump administration wants to do. And just cutting 75% of the agency fat in DC won't do that.